Hello everyone, welcome to Sense Business Studies. Today we'll be learning an IGCSE Accounting topic, bad debts. Please subscribe to Sense Business Studies and also subscribe to my channel. I'm having my own YouTube channel called Crazy IGCSE. This is my YouTube channel, you can go and subscribe. So let's get back into our topic. What are bad debts? Bad debts are amounts owing to the business which will not be repaid by the debtor. Now, debtor is the person who is in debt. It's like the debtor needs to pay to the business, which he has not paid. So that's when bad debts are created. That amount which has been owed by the debtor is not being repaid is known as bad debts. What are the reasons that bad debts occur? So one reason is that the debtor has disappeared, or the debtor has gone out of business, or it could also be the debtor is unable to pay because he has gone into loss. So bad debts written off is an expense, and now if all the reasonable steps to obtain the payment have failed, then the debt will be written off as a bad debt. Now let's look at the journal entries when the debt is written off during the year. So when the debt is written off during the year, the bad debt account is an expense, so the bad debt is increasing and thus it is debited. And the customer or debtor account, so this is one journal entry, this is the second one, and the customer or debtor account is an asset and it is decreasing, and that's why it is credited. Now if you want to know how to identify the journal entries, whether they're debited or credited, you can look at the previous video of purpose of accounting. Now at the year end, which means it will be transferred to the income statement at the year end, the income statement will be debited and the bad debts will be credited. So you need to remember that at the year end, bad debts will be credited and during the year it will be debited. Bad debts recovered. So bad debts recovered is when the debtor pays some or all of the owed money after the amount was written off. It could also be after a year. So here bad debts recovered means some of the amount or the full amount is repaid by the debtor to the business. Now the journal entries for bad debts recovered is the cash or bank account will be debited, and the bad debts recovered is an income, and the income is increasing because you're gaining the amount back which the debtor had owed to you, and that's why it will be credited. At the year end, bad debts recovered will be debited and income statement will be credited. So in the case of bad debts, the income statement will be debited, but in the case of bad debts recovered, the income statement will be credited. How to avoid bad debts? So first, you should not sell goods on credit and trade more through cash sales. And you should also check the financial position of your business, obtain references from new credit customers, fix a credit limit for each customer. Also, you can review supplies until outstanding amount is paid, and you could also charge interest on the overdue account. Improve credit control issue. Now let's see the difference between a reserve and a provision. So reserve is basically an appropriation of profit for a specific purpose, and provision is a charge for an estimated expense. Now let's see what it actually means. So reserve mainly means the money which is set aside by the business for an unforeseen loss in the future. So it is called an appropriation of profit. It is also known as savings and profit. And this can be a liability because a business has to pay to the owner. There are also profits plowed back to business. And a provision is the money set aside for a loss you already know will take place. And that's why it is a charge against profit and it is a liability. So the difference between reserve and provision is reserve is the money set aside for losses we don't know which will occur in the future, but provision we already know that a loss will occur in the future. And an appropriation of profit mainly means like the profit set aside. How much provision to create? Now how do we know how much provision needs to be created? So first you need to look at the individual debtors account, and then you also need to look at the past experience, and if the debt is for a very long time outstanding, this is outstanding, then there's a greater chance of bad debts occurring. Now, what is a provision for bad debt? So, provision for bad debt means it's an estimate of an amount that a business will lose in a financial year because of bad debts. So, we discussed what a provision means: an estimate of an amount that we already know that a loss we already know which will occur in the future. So, here you're estimating that loss amount the business will face in a financial year due to the bad debts. What is the purpose of providing provision for bad debts? Now, first, it's to apply the prudence concept. Prudence concept means the profits and the assets should not be overstated, and the loss and the liability should not be understated. So, the second reason is to satisfy the matching principle. Now, that is that the revenues should match with the cost of the period. Now, at the end of the year, what will happen to the provision for bad debts? So, the income statement will be debited and the provision for bad debts will be credited. Now, bad debts is an expense. So, in an income statement, which we'll be learning in further topics, in an income statement, the bad debt will come under the expenses corner, because bad debt is an expense, it will come in the expenses side. And we will put it in the expense side if bad debts is mentioned in the trial balance section, and we'll also learn about trial balance soon. Now, if the bad debts is mentioned in the additional information area, how will we record it in the income statement and the balance sheet? So, in the income statement, it's an expense, so we'll put it as for the bad debt. Okay, and in a balance sheet, we'll first write the debtors amount. After that, we will deduct the bad debts from the debtors, and that is if bad debts is mentioned in the additional information area. Now, provision for bad debts. Provision for bad debts is also known as provision for doubtful debt. So don't get confused, it means the same. So if for provision for bad debts, if it is mentioned in the trial balance, then in the balance sheet, we will write the debtors amount and then subtract the provision for doubtful debt or bad debt. Now, if we have provision for bad and doubtful debt or bad debt, if it comes in the additional information, then in the income statement under expenses, we'll write the provision for doubtful debt, and in the balance sheet, we will write debtors amount and then subtract the provision. Now, let's see if provision for doubtful debt comes in the trial balance and in the additional information. Now, if it comes in both sides, then we need to deduct both the amounts and see if for example in the trial balance it is 500 provision for doubtful debt, but in the additional information it comes as 1000. So here you're seeing an increase in the provision, and that's why if there's an increase, then in the income statement under expenses, you will write that difference amount. Like here the difference is 1000 minus 500, which is 500 again. But in the balance sheet, we will write debtor and then we will write the new provision amount. That means we will write the amount of 1000. Now, for instance, the amount is 1000, and then here it is 300, the new provision. So the old provision is 1000 in the trial balance and the additional information is 300. So now here you're seeing there's a decrease in the provision. So if there's a decrease in the income statement, we will write under income, we will write the difference amount. So here the difference amount is 700, and then in the balance sheet we will write debtor, then we'll write the new provision, or the new provision is 300. So this is how we do it for provision for doubtful debts. For more, check out www.sensebusiness.co.uk. Please subscribe, like, share, and comment. Thank you very much for watching Sense Business.